What's up, guys? Bulls and the Bears here with the weekly recap video. The first week of June is in the books. We have realized $86 in profits, which is kind of on the light side, but that's because so much profit, so much premium was pushed into next week due to rolling call options forward. So we're going to cover all that, but the trades that were locked up amounted to 86, but next week's looking over $300, so that's the discrepancy there. So combined will be over like 400 bucks by the end of next week if everything is collected by then. So very nice. A lot of moves were made this week. We're talking rolling, as I mentioned, cash secured puts that were opened and closed. We have a brand new position to the account, and I think I have a leap problem. I think I'm addicted to leaps. So we're going to talk about that. The account hit a milestone. Unfortunately, it didn't stay there. Here's the account. It dropped $335 today. It's a tough beat, but if the account's at $23,697 and it fell $335, where was it yesterday? Do the math. We were over $24,000. So if we go under the 1 week look and go to June 6th, which was yesterday, you can see we were over the 24K mark. We've reached that next $1,000 milestone. That's phenomenal. And then we gave some of it back. But still, we hit it. The account's looking good. It's just because some of my positions came down in market value, unrealized losses were building, or some unrealized profits came down a bit. That for sure happened with McDonald's. But nevertheless, the account is in very good standing. If I go to the 1 year look to capture all of it, you can see we're pulling back slightly from an all-time high. So doing pretty well there. Here are the positions. I mean, we got a full docket of stuff. The stock positions are the same, SOFI, Match, and Comcast. But the leaps, we have McDonald's leap, a Nike leap still, and a Snowflake leap. We did it. We did it. I bought the dip on Snowflake. So we're going to look at the chart, the fundamentals, go over why I got into it. The premiums are amazing. I already sold a call on it this week, collected premium there, and now I have one sold for next week for great premium as well. The Nike leap is up 257 bucks. That was struggling for a long time. Now it's up quite a bit, so we'll take a look at Nike soon. McDonald's is still profitable, although it pulled back by like $4 today. An unfortunate pullback with McDonald's, but it is what it is. Here's my Snowflake call for next week, my Nike call for next week, my McDonald's call for next week, and a Match Group call. Finally, able to sell a covered call on Match. I kind of had to break my rules to do it, but again, we're about to get into all the details, all the screenshots, all the receipts right now. So let's get into TradingView and we will get this underway. So we're going to start with the realized profits. What trades did we lock up and realize gains from? And we're going to start with Palantir for that. So Palantir, I sold a cash secured put at the 2050 level. I opened that last Friday on May 31st to wrap up last week. I got 14 bucks for it, the 2050 strike. And as you can see, Palantir this week, with the exception of Monday, which is a bit of a pullback on Monday, it was just off to the races, up to over $23. So my attempt to grab some shares at 2050 with a cash secured put did not prove to be successful, but I still made money. That's the beauty of selling options. You know, you sell a put to get shares. If you get the shares, you're happy. That was your whole intention. If you don't get the shares, well, you profit premium with no strings attached. It's kind of a win-win if you play it right. So when Palantir was rallying, the put decayed a lot. Premiums dropped, and I ended up buying it back for $3. So it was a net profit of $11 with Palantir. Next, we'll go on to RIOT. Same thing. I tried to get some shares at $8.50 on Wednesday. So the middle of the week, RIOT had a big collapse. It dropped as much as like 7% or so. As much as about 9% on Wednesday. Had a big drop. Let's go down to the 30-minute here. So on this drop here, I took advantage by selling a put because I was already interested in possibly picking up shares at the $9 level. I had sold puts there a couple times in the past at $9. And then it was giving me an opportunity to sell a put at 850, so that's an even better level to pick up shares. So I took that opportunity. On Wednesday, I sold the 850 put. I got 16 bucks for it. And the next day, later that day we rallied, and then the next day we rallied much more after that. The put decayed, and with just 1 day of time, I bought it back for close to 90% profit. I bought it back for $2 and profited 14 bucks there. Next, we'll go on to Comcast, my Comcast position, where I have 100 shares at $40.50, with the blue line here, marks my cost basis. And Comcast has been below that for a while, ever since its post-earnings drop. But on Friday, right here, this massive green daily candle, it rallied 3%, opening at $38.50 and going all the way to $40. That was last Friday. And in the middle of that push, somewhere around here, this is the big day right here, and this is the middle of that big day. Somewhere around there, I sold the $40 covered call. I've been selling the $40 covered call, and it gave me another opportunity to do so. So I'm just going to rinse and repeat that until I can't any longer. You can see that here, May 31st, I sold the 40 call. I got $24 for it, and that was expiring this week. But that day, it continued to rally, and it literally closed above 40 bucks. My call was in the money at the end of last week. This week hadn't even started yet, and I was already in the money. Possibly in a little pickle, you know. If it kept going, I would have had to either roll it out in time to move the strike up to my cost basis, or realize a loss if I get called away at 40. Either way, I wasn't that worried about it, but that was just the situation I was in. But as you can see, on Monday, it sold off, and Tuesday went sideways, and Wednesday it sold off. Thursday it popped up, which was great, up near $40 again, and then came all the way back down, and then slid a little bit today. So a red week, not really the greatest price action. I mean, if I go to the daily chart and look at this this daily candle from yesterday, this nice push here, only to be completely erased back down and closing red. A shooting star candle, not a good look. Big topping tail, even did it today too, tried to push up, completely rejected. So I'm seeing some unfortunate weakness here. This is the 4th time-ish that Comcast has tried to get to $40. And every time it's failed. And that's not a good look, because I need it above 40. That's where my position is, 100 shares. And I would like to get out of this, if I'm being honest. Even if it means getting assigned a little bit below my cost basis and taking a $50 loss. I'm actually fine with that, if that ended up happening. But it's pulling back now, back below 39 bucks. Not great, but this covered call did expire worthless, and now it's gone. So that $24 credit right here that I collected, I kept all of it because it went to zero. So I profited 24 bucks. It looks like I even got 1 penny. 1 cent from the Comcast stock lending program. How about that? So I made an extra penny there. I'm not going to count that, but I guess that happened without me even realizing it. The last profit on the week, realized on the week, was with snowflake. So now we got to talk about this. And we have a lot to talk about, because I got to explain why I even got in it in the first place. So here's Snow, the recent daily chart. Looks pretty rough, doesn't it? I mean, we're talking it dropped 20% over the past couple of weeks following earnings. It looked like it gapped up after earnings, but then sold off, finished down 5%. And then there was some type of like data breach, some type of hack that happened to them. And it's just been kind of in a downfall. But if I go back, zoom out here on the weekly chart, you can see going as far back as May 2022. So the last 2 years, this area down here around 120, 130 has been some strong historical support. That's actually been the low of the whole entire life of the stock, because it IPO'd, looks like, back in 2020. So it's relatively new, and it's been supported down here at like the 130 area, and that's exactly where I bought my leap. So from the chart perspective, I'm liking that base. Now let's take a look at some of the fundamentals, which I'm going to use TradingView for. So I'm going to go on the right side, click See Forecast under Analyst Rating. So first of all, the analyst ratings are very promising. Out of 47 analysts, 28 say strong buy. So the majority say not just buy, strong buy. 6 say buy, 11 are hold, and 2 say strong sell. So that's encouraging. It's not the be-all end-all, but it is encouraging. Here are those analysts' price target. So the average price target is $200 a share. That's pretty good. That's $70. That's 50% upside from here. The max price target is $240, but that's kind of pie in the sky. The minimum, though, this is saying something. The minimum price target is only 4% down from where it is right now. So what I'm seeing is a lot of upside and not a lot of downside. This seems like a good trade to take, right? The odds might be in my favor, it seems like. I believe they are. Doesn't mean it's going to work that way. Even if there's a 20% chance of losing, you can still lose. So hopefully this doesn't become a problem, but based on these numbers, I'm liking it. But more fundamental stuff, EPS has been good. It's been positive and rising. Now, this is adjusted EPS. So if you actually look at their net income, their GAAP net income, their non-adjusted net income, it is red. It's negative. They've been losing money. But when I looked at their statements and their balance sheet and all that, their income statement, the biggest reason for their net loss every quarter is their stock-based compensation. They're paying their employees, they're incentivizing them to work for them and work hard and build the company by giving them stock-based compensation. That's one of the biggest expenses that's leading them to have a net loss. And what they do with adjusted earnings and adjusted net income is they strip out certain expenses that aren't necessarily indicative of the company's performance. So they strip out, when you strip out the stock-based compensation, they actually have a net income, a positive net income. And here's the positive EPS readings here. So that's what I want to see. Revenue down here is increasing every quarter, which is great. Let's go to some more financials. Let's check out their cash. So I'll go to their balance sheet. I really want to look at their debt. So total debt is about 280 million. And if I go to their cash, total current assets, cash is 3.5 billion. So 280 million in debt, 4 billion in cash. And if you want to combine those two figures, you get the net debt down here. Net debt is minus 3.25 billion. That means they have 3.25 billion more in cash than they do in debt. A negative net debt is good. That means there's more cash than debt. If it's positive, that means there's more debt than cash. So I love the cash balance. I love how they don't have a big debt load, because debt does slow down growth, especially in a tech company. Net income, revenue's rising. And if I go to visual stocks, which is a nice tool, it shows you a lot of cool metrics right here. And here's the name, visual stocks, but with a Z, VIZUAL stocks. It's free to sign up for. You got to get an email and password to make an account, but it is free. There is a paid section where you can get all these extra charts and ratios. You can see it's locked here because I don't pay for it. I've considered it. And you can also build your own charts too on this, and with your own metrics that you want to look for. But the free version does show you a good amount of stuff. Customer count is going up for Snowflake. Clients over $1 million in revenue has been going up nicely, up and to the right. Product revenue and product gross profit all going up and to the right. Revenue down here. The only thing is the net income, which is a loss, but I just told you why when you adjust for that stock-based compensation is actually positive. Cash flow has increased. Cash to debt is great. The debt is the red bar, which is very small relative to the green bar, which is cash. Shares outstanding are slightly increasing, so a little bit of dilution, which is common for a brand new company, but I don't foresee it being a huge headwind on the stock price. So overall, I like what I'm seeing. I like to add a little bit of tech growth into the account, have that volatility, have that really good premium generation, those big upside returns potentially. It's good to have that mixed into the portfolio. And as much as I'd love to have something like Amazon, right, or even Tesla, Google, Nvidia even, the charts just aren't really appealing to me. I like to be conservative when looking at a chart. I like to buy stocks at support. Amazon is just off to the races. Here's Amazon. It's just up and away. Like, it could keep going, which means why not play it right now? It could keep going, but I don't want to be caught at the top when it retraces 10, 15%. I would rather buy at a good support level and put the odds in my favor that it's about to rally as opposed to could roll over at any point. I just don't like to trade that way. And Snowflake gave me that opportunity to buy something in that tech space at a solid level of support right here. So that's the rationale of me getting into the trade. I got in on Thursday right here. So yesterday I bought the Leap, and here are the details. This is the receipt here, the account history. So I bought the 110 call, which is $20 in the money. So it's deep in the money, not quite a delta of 1. The delta is like 75, 80. But it was really expensive to get further in the money with a higher delta, so I just took it at that. I paid $4,100 for it, so that's the same cost as buying 100 shares of a $41 stock. But instead, I'm synthetically owning shares of a $130 stock, one that's very volatile too. So that's the nice leverage play you can do with Leaps. So that was the cost, $4,100, the $110 call. It expires June 20th, 2025. And that day I sold the 136 call, which was about $3 above where I bought the Leap. So this white line here, price of snow at time of purchase, that is when I bought the Leap. And early on in the game of this Leap's life cycle, anything above that white line, the Leap should be profitable. Just like buying any option. As soon as you buy it, any call option, if the stock goes up right away, you should be profitable. And that's the same situation here. If it's above where I bought it, the price of snow where I bought it, it should be profitable. And in this case, theta decay works so slow that that should be the case for a little while. So as long as it's above 132.73, where this white line is, the Leap should be profitable. It's not. It's below it, so it's at a loss right now, but that's okay. The premiums are crazy. I sold the 136 call the day I opened the Leap for this Friday. So it was literally a one-day trade. I opened it on Thursday for Friday expiration, and I got $42. And it was the 136 strike, which is $3 above where I bought the Leap. So I had $3 of upside on the Leap plus the $42 in credit, which is a massive annualized return. Like, that's more credit than I need on a whole week, and instead I got it in one day because of my $4,100 investment. That's a 1% return. $42 is over 1% of $4,100, and I got that in one day, just for context. So that's what I collected at least. I ended up buying it back today, though, the very next day for $5, and I profited $37 on that covered call. And then I opened one for next week at the 137 strike, even higher now, giving myself even more upside on the Leap. And I got $105 for it, guys. $1.05 on the contract. I mean, look at this. The white line is right here. Anything above this white line, the Leap is profitable. And I sold a covered call way up here. $5 above that price. And it was like $6 or $7 out of the money at the time I sold it. Probably more like $6. And I was still able to get over $100 for just 1 week. That's insane premium, while still offering me like $400 of an upside on the Leap itself, aside from the covered call premium. So this is the beauty of a stock like this, especially when you do it with a Leap, which is a cheaper or lower investment. So that's the beauty of adding a name like this to the portfolio. It has the volatility, which could work against me, but those premiums are going to be very nice to collect. And I'm still going to give myself so much upside too, even with those high premiums. So that's the position I'm in now. Made that profit on that one-day trade, and now I have $105 I stand to collect next week just on this covered call, and we're going to go from there. I mean, it is weak right now, but I'm hoping this overall support area will hold up and we'll get a nice little pop. I mean, this thing can move quickly, as you can see. So we spent a lot of time on that. We're going to try to go through the rest of this kind of quickly, but no promises. We'll go to McDonald's next. This one had an unfortunate Friday. Today it dropped $4.50, which hurts because, as you can see, it was having a really nice push here the last week and a half. I bought my Leap at this white line, just like the Snowflake setup, at $2.55, and when McDonald's was up here above $2.60, hitting $2.62 even, my Leap was up like $700. But now it's up like 150. So unfortunate retracement there. I did have covered calls on this thing that I managed, so we'll take a look at that. This actually has to go back to next week to really explain the whole story. So Thursday of last week, I sold a covered call at 255. And that was just a one-day trade. I sold it last Thursday for that Friday expiration. So just a one-day to expiration trade, and I got 22 cents for it because that was good premium for my investment for just one day. But McDonald's had a really strong day on that Friday, which was right here. This was the Friday where it pushed almost $7 a share. So it exploded on Friday, which put pressure on my covered call. It was getting in the money, so I had to roll it. So that Friday, I rolled it up to the next strike, the 257.50, and I got 45 bucks for it, for that net credit. So entering this week, I had a covered call at 257.50, which is right here, right about here. And all week long, we were in the money. This covered call was in the money all week long, and I was getting prepared to part ways with this position. The call was in the money, quite a bit in the money, so it was really hard to roll it for a credit again. So I was just about to say, hey, it's been fun. Let's just end the trade for a nice profit. But then today, McDonald's sold off. It sold off hard, harder than I wanted it to, but McDonald's pulling back today actually allowed me to roll the call out and up for a net credit. And if I bring up the history again, you can see 7 hours ago, I rolled the call for another $42 net credit. And I rolled it up from 257.50 right here, this white line, up to 260 where the current green line is. And the net credit on all of those rolls combined is $109. And that's just the 22 bucks from the first call, plus the 45 net credit on that first roll, plus the $42 credit on the second roll. All of those credits are lumped up into one, and I'm not going to realize any of it until that trade ends. As long as I keep rolling it forward, the net credit's going to keep building, and I'm not going to realize any profits. It's only when I finally close it or I let it expire worthless that I'll realize all those premiums at once. So that's why this week is kind of very low profit, because all this premium that I was supposed to collect this week, I pushed it out to next week. So an unfortunate sell-off today. Hopefully it comes back up. I have my covered call at 260, so if it does get in the money and I have to close the position above 260, I'll have about $500 on the leap plus all the credit received. So that'll be a really nice profit. I have a lot of upside by rolling these calls out and up these past 2 weeks. Now let's go on to Nike, which is the same story as McDonald's, except it's been having a hell of a week. I mean, look at this move. They broke out of this triangle here, and it's been off for the races. It hit almost, it was just shy of $98 a share today before pulling back to about $96.50. So it's been having a really good run the past couple of days, and as a result, my leap has been enjoying it. That's why it was up about 280 bucks earlier in the video. I did have covered calls against it though. I had a covered call sold at the 95 strike this week. But on Thursday, when I saw Nike having that nice push higher and my 95 call was getting threatened, I decided to try to roll it out and up to give myself more upside and collect more premium. And I was able to do so for a sufficient credit. So we'll bring up the history here. Lots of stuff. Just like McDonald's, this goes back to last week. Because last week I sold the 94 call. And I got 30 bucks for it. Later that week, I ended up rolling the call out to this week and up to the 95 strike, and I got $32 net credit. And then this week, yesterday, when 95 was being tested, I rolled it again to the 96 strike out to next week, and I got another $33. So 30 bucks plus the 32 on the net credit last week on the roll, plus the $33 on this week's roll, gives me a net credit of $95 that I'm waiting to collect when I finally close the covered call campaign on this. But what's nice about these rolls is that I'm rolling it up. Every time I roll it up, I'm giving myself more upside on the underlying leap contract that I have. You know, every dollar per share my covered call increases, that gives me another $100 of upside on the leap itself. So that's why it's nice to roll it out and up. But I'm only going to do that if I can collect a nice net credit. If I can't, then I'm just going to end the trade. In this case, I was able to do so. So now I have the 96 call, which is in the money, but I'm not going to be able to really make any moves until next Friday when expiration day comes, and then I'll evaluate the situation. If it's still in the money by a lot, then I'll just close the trade for a profit and end it there. If it's not that far in the money, but it's pretty close, I should be able to roll it out and up again. And if it just sells off, then the calls will just expire worthless, and that's that, and that'll be unfortunate, but it is what it is. So that's the game plan with Nike. Very nice push here these past couple of weeks. Next, we'll move on to Match Group, which finally I was able to do something with because it had a really good week. It's just been pushing up nicely, and on Thursday it moved 4% to the upside, closing at the high. So Thursday was a great day, and that was the day I actually decided to sell a covered call against it. And I did so prematurely. I mean, this thing I haven't been able to do anything with for over a month. It's been dead money for a little while. So as soon as I got the chance to sell a call even close to my cost basis, I took it. Just like with Comcast, I broke the rule. I sold it below my cost basis of 34 bucks by selling the call at 33. So the blue line is my cost basis of with 100 shares. The green line is where I sold the call. So it's below it, which puts me at risk of getting in the money at a place I don't want to sell the shares, but I'm also really not that worried about it because I wouldn't mind just getting rid of this position, even if it costs me some money. It's okay. But I opened the call when Match was having this push here. I was like, wow, this is a really strong push. I can actually get the 33 strike. I might as well just do it. And that's what I did right here. June 6th on Thursday, I sold the 33 call, got 27 bucks for it. Little did I know it would keep going and going and going on Thursday after I sold the call, to the point where I could have actually sold the 34 strike right where my cost basis is. I could have sold it and would have been fine. No risk of selling the shares below my cost basis at all. But I didn't think it would have that crazy of a day. So I jumped the gun a little bit. But today it actually pulled back down to $32. So now there's a little more breathing room between the current price and my covered call. It's not so much under pressure anymore. But this goes to next Friday. So there's still a lot of time left. So I could still very well get under pressure here on my $33 covered call, but that's okay. I'm just glad to finally have some premium working on this position because it's been over a month. So 27 bucks at the 33 strike. That goes till next Friday. Now we wait. Lastly is SOFI. Nothing happening here. It's been sitting around 7 bucks. Not able to sell puts, not able to sell calls, just sitting tight. So that is the weekly recap video, guys. That was a long one. Had a lot to explain. Thank you for sticking with me if you made it this far. Overall, $86 in realized gains this week. That's very light because a lot of the profits that I could have had this week were pushed out to next week. Next week, I have as much as $336 in premium that I stand to collect. I might not realize all of it because I might close things early, or I might roll again, you know, push it out even further. But that's how much premium I still have in the pipeline coming my way. So this is shaping up to be a pretty good month already, and we're only 1 week in. So I'm happy about that. The account's looking good, pulling back a little bit from all-time highs. So we're rocking and rolling right now. Hopefully the market can keep chugging along to the upside. Regardless of what it does, we're going to stick to our rules, manage our positions, sell puts, sell calls, collect premium, take profits, all that good stuff. Whatever happens, I will be here every week to show you guys how I do it. So until next time, guys, thank you for watching. If you enjoyed, hit the like button, subscribe for more content, and I'll see you all next time.